area. Let's get a quick update on the fixed income space. And joining me in the studio to discuss that is Ini Ebong. He's the Group Treasurer at First Bank. Ini, it's great to have you on the show today. Let's start with this cause of the excess liquidity that we're seeing in the system now. Of course, we know the central bank maintains that tight a monetary stance, but it would be good for you to explain your understanding of the dynamics at play right now.
Thank you, Didi. Well, basically, the central bank has two effective tools in managing surplus liquidity. One is through its direct interventions using its open market operations, and secondly, it's through its sales of foreign exchange through its bi-weekly auction at the WDAS window. Now, what has happened is, as a byproduct of the foreign portfolio investor interest in Nigerian securities. So as they bring in foreign currency, they monetize that, convert it to Naira to buy these instruments. So it limits the central bank's ability to mop up liquidity by taking it out via FX sales. So it's largely a byproduct of that, and that liquidity is still subsisting within the economy.
Okay, now a lot of people are talking about the central bank's decision to bar foreign investors, which of course you mentioned now, from buying OMO T-bills. Do you feel that this is justified?
Well, when you think of monetary policy management, you've got to look at the whole spectrum of the curve, effectively. Now, from the central bank perspective, given the government's cash cycle, where you've got monthly releases of liquidity arising from revenue distribution at the end of each month, it compounds their ability to do so effectively. I mean, historically, they only allowed foreign portfolio investors access to the longer part of the curve. But you have to strike a balance. From one angle, you would want for foreign interest so that you expand the marketplace, but it really is, they have to strike a fine balance. And at this point in time, I think they are struggling. The central bank is struggling managing the liquidity, and I guess that's what's informed this policy measure.
So do you feel like that task will become easier or tougher for them in the short term?
Well, in the short term, it will only get tougher, given the government's fiscal policy stance, the sheer quantum of portfolio funds in the market today, and the fact that we are seeing the portfolio investors to some extent migrate from the longer tenor securities to more shorter dated securities. So it gets more challenging.
Okay, now, of course, given the liquidity levels that we are talking about, a lot of people say that MPC will lower rates at the May meeting. So what are your expectations?
The central bank's stance has been very clear, and I think they've telegraphed that well to the market, and it's anchored on two things. One, exchange rate stability, and the clear mandate to manage inflation. Given what we see, my view is that I think they will maintain the current stance. So that leaves very limited scope for policy rate reduction, in my view.
Okay, let's quickly talk about the number of banks that are offering debt in the market. Of course, recently we heard about Fidelity Bank doing that. Now, your thoughts on the pricing and attractiveness of these securities that are being offered?
Well, if you look at the global macroeconomic frame right now, the marketplace is ripe for issuance from Nigerian and other sub-Saharan African corporates that want to access the markets. The conditions are just right. Global interest rates are low. So we would expect that banks would like to tap into these opportunities as they exist today. We saw the Fidelity issue price at about 7%. I thought that was excellent pricing at the time. There clearly is appetite. There is a lot of interest from global investors. So I think people will continue to tap the markets and take advantage of the rates right now.